Good afternoon, everyone, and welcome to today's webinar. My name is Connie Shijara. Thank you very much for joining us for today's webinar. We are really privileged to have Matt Mullins today speaking about decision-making analysis in the minerals industry. Just a quick bio on Matt. Matt Mullins is a mining industry professional with over 40 years experience. He has worked in major and mid-tier mining companies as a consultant, a mining analyst, and in rock engineering research. Some of these companies include BHP, Barrick, Severn Mining, and Gold Fields. He is currently an executive consultant with Snowden, based in London. He has worked in multiple commodities, mainly diamonds, gold, PGEs, aluminium, and many others. And these were all in multiple geographies and across the mining value chain. He was a member of the Chief Operating Officers Council for BHP Billiton South Africa, headed up brownfields exploration for 5 years, and headed up productivity for both BHP. He has been closely involved in the development of global resource reporting standards since 1994 and was president of the Geological Society of South Africa in 2008 going into 2009. Please enjoy the presentation, everyone. We will be having a question and answer section after the session, so please post your questions in the Q&A box. Thank you.
Thanks, Connie. Can I just confirm that you can hear me and that I'm coming through loud and clear? Yes,
I can hear you perfectly.
Thank you. Well, welcome to everyone who are attending today. I recognize a number of names, Mark, Gordon, Michael, and others. And for those of you who I haven't met yet, welcome to you as well. And I hope that you enjoy this discussion on decision analysis in the mining industry. I'm introducing this topic as one that is exceptionally important to us and one that I hope is going to stimulate a fair amount of discussion amongst yourselves on how we make decisions, how effective we are, and how we avoid introducing bias into our decision-making process. I have a couple of slides that I'm going to talk to, and Connie, I'm just going to pull up my screen and share it, and then we'll talk about that. I have about 45 minutes of basically talking to slides, and then hopefully we'll have 10-15 minutes at the end to talk about a couple of topics that are of interest to you, and that hopefully, as I said, that might be stimulated in terms of the discussion that I'm going to introduce. So I'm just going to share my screen, and if we can just confirm that we can all see it, I'm just going to get onto slideshow. Connie, is that coming through?
Yes, I can see it. Yeah, it's coming through.
Thanks. So, and thanks very much for that introduction. As you say, 40 wonderful years in the mining industry. I've been privileged to work across the globe, across commodities, for many absolutely wonderful companies, and I consider myself to be have had a wonderful, very interesting and very fulfilling career, and hopefully still much ahead of me. So thank you for that. That was my introduction. So what I want to just cover today very quickly is where we are at in the industry today. Have a recap of the project pipeline. Most of you would be fully aware of it, but I want to introduce a couple of issues around that, where we create value in terms of the what we call the S-curve. Quick look at valuation approaches and how we introduce 4 cash flow streams, and then talk a bit about what prevents us from making good decisions, and talk about how we can actually overcome bias. Now, in decision making, there are many factors that come into our decisions, many of which I'm not going to discuss today. I'm talking about regulatory approvals, talking about environmental approvals, I'm talking about the whole ESG space, which is becoming more and more important. I'm really going to be talking more about the technical aspects of what we produce to help us make those decisions, and I'm going to be talking about bias. So those are the 2 key things that I'll be talking about. So please don't for one moment think I'm ignoring all of the other aspects that come into the critical aspects that impact on our decisions, but I am going to be focusing on those ones. This seminar is designed as a series of 3, and the next 2 are, I'm going to be talking about productivity. As Connie said, I ran productivity for BHP for a couple of years, and many of the lessons that I learned during that period are just as relevant today, and I want to share some of those ideas and lessons with you in the next seminar. And then finally, a topic that I know has been covered by many very, very good commentators and speakers, but I will give you my perspective on the economics of project development. There's a 3-day course which we're planning for October, which is the economic evaluation of mineral deposits, which will be go into a lot of these sort of topics in more detail, particularly from a hands-on point of view. In other words, actually working with financial models, working with productivity models, and working with project development models. So that's as an introduction. On the bottom left is a video. Connie, I didn't confirm that, but I'm happy to share the slides with all of the attendees today. And you will see a YouTube video to have a look on how Chevron does their decision analysis. I'm not going to show you that video, but I encourage you to have a look at it. They credit the kind of process that I'm going to show you with having saved themselves $2 billion in terms of their decision making over the last decade. Have a look at it at leisure. So let's go straight into it. Where are we at in the industry today? So this is from mining.com's excellent compilation. They quarterly tot up the market capitalization of the top 50 companies in the mining industry. And the latest one that we have is at the end of June, with the mining industry having marched on to an incredibly impressive $1.47 trillion in terms of the market capitalization, which is a very, very good proxy for the size and also the health of the industry. Now that compares to not so long ago, about 4 years ago, of about 900. So we've come on enormously since then. I think that 18% is wrong, by the way. I need to check that. But not only that, we've also recovered from the pandemic, as you would well know, incredibly well. The minerals industry has been one of the great winners out of the pandemic. We were really went down in March 2020, and we've not only recovered that, but we've come on in leaps and bounds since then. We've added, just from March, April last year, in stunning $700 billion to market capitalization. Now, in terms of the size of the industry as a whole, I haven't actually worked it out really precisely, but I would say that the total size of the industry is about double of that 1.47. So you're looking at an industry of about $3 trillion, which compared to many other industries in the world is not that large, yet it is still significant, and it's a significant driver of overall wealth and overall improvement of living standards throughout the world. I won't go into that in too much detail. What does set the mining industry apart, and you all know this, are 2 aspects of it. Firstly, it's a capital intensive industry, hugely capital intensive. And secondly, we're dealing with a wasting asset. Replenishment of resources is a critical part of the minerals industry's health going forward. I've done various estimates over the years on how much we spend on capital development, and it's about 15 to 20% of the total market capitalization of the industry. It's probably a bit lower now because the market capitalization has run ahead of the expenditure on projects. I've also done a couple of exercises on what that money is spent on, and I'm reasonably happy that about 50% is actually spent on maintaining our resources. So spent on just sustaining capital, keeping our projects, our operations going, expanding them, and extending their lives to a certain extent. About 30% of that capital is on greenfields projects and about another 20% on capital on brownfields. Now that varies because some of what I've called sustaining capital could possibly more rightly be termed brownfields. However, just a word of warning, the definition of greenfield, of sustaining greenfields and brownfields is not consistent across the industry. It's not, various companies put the capital expenditure into different boxes. My definition tends to be between greenfields and brownfields, anything that can share existing infrastructure and facilities tends to be brownfields. If it can't, tends to be greenfields. That does get blurred when you look at major mineral provinces like the Pilbara iron ore, where an enormous amount of infrastructure is actually shared. In addition, this is a number from last year. I think about $17 billion was spent on M&A. It did come back quite strongly in Q4 last year. There were 21 deals in 2020. And to that, we need to add in, if we're looking at total expenditure, what we spent on exploration, I think, can't remember exactly, about $6 billion last year. So you're looking at a significant amount of expenditure globally, anything from 100 to 150, if not more, $billion spent on capital. Every single one of those projects, every single one of those acquisitions, and even in the exploration space, we need to make decisions. Decisions to go ahead from one phase to another, decisions to actually build mines, decisions to actually buy mines or buy operations or buy companies, and decisions, for example, to continue exploration. So that's where we're at. I'd say, in a nutshell, the mining industry is in a very healthy position. We've seen prices at all-time highs, although a little bit of weakness recently, especially in iron ore, copper and gold. But in some commodities, we've seen really, really strong prices, and long may it last. I wouldn't be surprised if they do come off a little bit, but let's see how it goes. I think the demand for physical metals is going to remain strong, even if prices do show a little bit of weakness in the short to medium term. So let's go straight on to the project environment, where much of our money is spent. We recognize in the mining industry, and pretty much every company that I've been involved in recognizes the project pipeline. There are various names for these phases, but generally recognized as the concept study, the pre-feasibility, the feasibility study into execution, and becoming an asset to a company or an operation. Critically, the point I want to make here is that our thinking needs to change through that project pipeline from concept study, and prior to that, remember, as advanced exploration, we need to have a certain amount of strategic thinking. Is this the right commodity? Does it fit our company strategy? Are we in the right geography? Is it the right size that we're looking for? As we go into pre-feasibility study, we move into what I call divergent thinking. We're starting to look at a project as to how we will develop it. What are our opportunities? Are we going to go open cast? Are we going to go underground? What are our processing options? How big should it be? All of those which culminate at the end of feasibility at a single go-forward option, which we optimize in feasibility and into execution, and that I call convergent thinking. So we're trying to make sure that our single go-forward option is optimized. Valuation approaches are linked to this project pipeline. So as you can imagine, those of you who have been involved with building financial models, a model that for a pre-feasibility study needs to be able to cope with multiple options, and with a feasibility study has to have a fair amount of additional detail in it. Where I've shown those little triangles are those where key decisions in the project pipeline are made. So they're called toll gates or whatever they are in your company or operation, but those are key decision-making milestones where we need to actually have the information at our fingertips to make the right decision. Do we proceed in the next phase? Do we stop our project there? It's often harder to stop a project than to proceed with a project, as I know from hard experience on a number of projects that I've worked on. So let's move on. Let's turn to the S-curve. Now this, I think there were a number of very, very good papers and theses written in the 80s and in the 90s, and over the last 10 years, this has become pretty much accepted in the minerals industry. The steep part of the curve is where the maximum value is created. And I've called it from concept study. I haven't defined it exactly where that would be, but that would be on the flat part of the curve at the moment. Advanced exploration into concept study. The steep part would really coincide with the pre-feasibility, tapering off at the top side into feasibility study and into execution. For many projects, the cost of doing those studies can be significant. If you're looking at a big base metals project or a big bulk materials project, you could have a cost that runs into the millions of dollars to actually do that study. So the cost of those decision points is not insignificant. It actually is a significant amount of expenditure that we are committing there. Value can be reset, just as a point here, through changes in technology, through actually finding more material through brownfields exploration adjacent to your existing operation or existing project, and through productivity. Now, I'm going to be talking about productivity and how you can reset value through productivity changes in the next seminar, so I won't go into that in any detail. If we go on to the key deliverables in, let's say, the concept, pre-feas, and feasibility, remember the concept study, all you have to do is show that you've got a business case, that it fits your strategy, that you've looked at the various alternatives, and that you've got a plan for the pre-feasibility. For the pre-feasibility, you really have to look fairly widely. Some companies and operations look very widely in terms of the options that they study. Some limit the number of options, and I'll show you technique on decision analysis that I'll show you helps you to limit those options. But the key outcome, as I said earlier, is firstly that you have to have a viable option to progress to feasibility. But secondly, that option, you happy in your mind, is the right option to pursue in feasibility study. Once you get into feasibility, the minute you start looking at various options again, you should take yourself back into a pre-feasibility study and be absolutely rigorous about that. Feasibility study, for the final go-forward option, and remember, this is the big money that's going to be committed, is really, have you selected the right option? Not have you selected, have you optimized the right option? Are you happy that the maximum value has been extracted from that? And there, again, use of value improving practices and a number of optimization techniques like that are absolutely critical to making sure that the feasibility is fully optimized. If you look at the bottom line there, it varies per company and it varies according to who you talk to, but in terms of the level of engineering definition, and that's how much you've actually studied the project in terms of looking at how you're going to build it. For concept study, anything from 20 plus 20 to minus 35, pre-feas plus minus, or 15 to minus 25, and a feasibility study generally about plus minus 10%. And as I say, it varies per company and per industry and often per commodity as well. Those numbers are from the SAIMM monograph 27, the excellent cost estimation handbook. So let's just talk how we're going to value it. Firstly, most valuation codes, and I'm talking about Valman, the excellent SAMVAL and SIMVAL and others recognize 3 approaches to valuation, which is the income, the market, and the cost approach. And the within each approach, there are a number of methods. So just give you an idea of that. Within the income approach, which is our one we would recognize as our discounted cash flow approach, there would be various methods that you could use. Options analysis, for example, would fall as a method within an income approach. The codes do require us to look at 2 approaches whenever we do a valuation. The second one, importantly, it requires us to report our values as ranges. I won't go into the market approach or the cost approach. The rest of the discussion here is going to focus on the income approach. So in simplest terms, the income approach requires us to estimate what we call the 4 key cash flow streams. Number 1, being production and revenue. Number 2, how much capital are we going to spend on developing the project? Number 3, how much is it going to cost us to run it? And number 4, how much are we going to pay in taxes and royalties? Accumulation of all those 4 cash flow streams allows us to estimate the free cash flow and a number of financial metrics for which we can summarize in terms of what I call the 4 key or the 4 major metrics, which are net present value, internal rate of return, the payback period, and the capital efficiency ratio. I consider those to be the 4 key decision-making metrics that arise out of a cash flow analysis. So there are a lot of inputs that I'm not going to discuss now that get discussed in other seminars. The ones like what discount rate do we use? And we all know that cash flow analysis, when you're discounting your cash flows, is enormously sensitive to discount rate. What price do we use? So just in terms of discount rate, I would strongly recommend going for a weighted average cost of capital approach wherever possible, adjusted by the country risk. I'm not a great fan of introducing an additional discount percentage for project risk or for phase risk. But that's a personal preference, and I know there are many people who would disagree with me. In terms of what price do we use, I certainly am a fan of looking at forward curves and using that to guide what price we use. Those 2 subjects alone could consume many seminar hours, and I'm not going to digress into them. We can maybe talk about a little bit about it at the end. Your production, though, definitely comes out of a good ore body model and a good mine plan. And those are the fundamental aspects that drive your cash flow at the end of the day. Together with your metallurgical aspects, your recoveries, your deleterious elements that will prevent you from realizing your full price, those are the key aspects. Capital expenditure, I'm also not going to go into in too much detail or in any detail at all, really, but the estimation of capital nowadays has become a very complex and quite difficult subject. You can have 2 estimators or 2 estimating companies coming up with vastly different numbers, and I am concerned that in many respects those numbers are driven by the state of the industry at the moment. Appreciate any comments on that at the end of the talk if you do have any. OPEX, I think the driver of OPEX often is in country. Much of our costs are based on capital, in labor intensive operations, on labor costs. The inflation rate is critical, and how much of our supplies are sourced in country versus out of country. I'm also concerned with inflation rising globally at the moment, and we've seen that in the United States, we've seen that in Europe, and we've seen it in a number of jurisdictions that our OPEX is going to rise significantly in the mining industry in the next couple of years. I don't want to appear to be alarmist, but I think it is something that we need to keep a very, very close eye on going forward. Taxes, there are some countries that are starting to go back to looking at increasing the resource rent, and that's also something that we need to keep a close eye on, especially with ESG becoming really, really important, and quite rightly so. We need to see how much the cost of doing ESG properly in the mining industry is actually going to add to our overall cost of production. And that's something that I know a lot of people are exercising their minds around very, very carefully at the moment. I do know that, for example, the JORC code has a subgroup looking at the cost of ESG at the moment. So let's turn to those 4 metrics, what I call my prime metrics, and just unpack those a little bit. So net present value, it's a measure of the cash generated after paying back the company shareholders and the company lenders. That is why you have to have a discount rate, because there's a minimum discount rate, which is, as I said earlier, based on weighted average cost of capital plus country risk, which a shareholder will expect a return above that. If there's a surplus, then that generates value for the company. And theoretically, any NPV greater than 0 will increase shareholder value. And that's stands to reason, but most shareholders would expect a little bit more than just an increase of $1 over shareholder value. The internal rate of return is more a measure of the intensity of returns. So this is a bit more of a difficult one to get our minds around, because it also has an assumption that may or may not be true, and that is that any surplus cash is reinvested at the same rate. And that's not necessarily true, but so I take internal rate of return sometimes a little bit with a pinch of salt, especially when I look at internal rates of return above 20, 30, 40%. I've said that the range of internal rate of return down the bottom can be anything from a few percent. Remember, this is above your rate of return. So internal rate of return of 12%, the discount rate of 8% would be getting 4% above your discount rate. Sorry, it would be 12% plus 8%. Remember also, we have to work in real and nominal terms. In jurisdictions which tend to have high inflation, nominal is popular, and then converting it back to real, we often get that wrong. And we need to be careful of that. I tend to recommend that everyone works in real terms only, but it's not, you don't always get your tax right if you do that. What are typical returns? A large greenfield project would often get a return of 10 to 15%. A brownfields expansion project will often have returns up to 50 to 100%. You can look at the Anglo Platinum, I think the latest Anglo report or presentation. Their brownfields projects are ranging sort of the 30 to 50% or more. And that is my experience as well. Brownfields projects tend to be the greatest value generator in terms of an internal rate of return, not necessarily in terms of NPV. Payback period is you can look at it, remember, you have to specify whether you're looking at it in terms of discounted or undiscounted rate, cash flows, but it's a very, very useful metric to have a look at how long it'll take to pay back your money, especially on a discounted basis. Now, I have seen payback periods of a couple of days. I think Marsfontein paid back its capital in a couple of hours, that very rich diamond mine. And I've seen payback periods for large bulk projects of over 10 years. So anything up to, say, 15 years I've seen. I haven't seen anything beyond that. You obviously have to be in it for the long term if your payback is going to be that long. A project that I worked on in Chile in 2004, Spence had a capital expenditure of $1 billion, and it hit the sweet spot in terms of the rise in the copper price and paid back that $1 billion in 11 months. That is unusual, but it is possible to pay back that amount of capital in a short period of time. Capital efficiency ratio is one of my favorite metrics, and that is purely and simply the ratio of the NPV to the initial capital investment. I have seen capital efficiency ratios for projects that have been approved of as low as 0.1. I would say that if you're not looking at a capital efficiency ratio above about 0.3 or at least 0.5, then you should really look at the other aspects of your project. Generally, above 1 would be a really good capital efficiency ratio. Where CER is extremely useful is in the ranking of projects. So we need to move on. The last comment on this one is that payback can be linked to resource confidence. So many banks or many investors would want a certain amount of high confidence resource in the measured category, for example, in the payback period defined, in the mine plan defined by the payback period. And we can look at that. Those are rules of thumb. It's not built into any resource reporting code, for example, or reserve reporting code. Moving on, that's the basics. Now we have got better in decision making in our capital projects and M&A decisions. If you go back to the 80s, there were a number of really horrendous decisions made. In the 90s as well, I think of a bunch of decisions that were made by pretty senior companies, and I'm not specifying that bad decisions were made by large or small companies. I think it was across the board. So I think not enough thought had gone into how we make decisions. And this is the aspect that I think really trips us up, and that is what prevents us from making good decisions. Why do we not follow the math, for example? Why do we tend to follow our intuition in mining? Quite often we ignore the math. Quite often we will look at the numbers, for example, and say, no, but this, don't worry about the NPV. Don't worry that the internal rate of return is negative. This is a strategic decision. Or we're doing it as a company builder. I would caution against those sort of statements. Whilst I understand it, I do feel that many projects and many acquisitions in the past were done in defiance to a large extent of the numbers that we come out of from our extensive studies in terms of concept, pre-seeds, and feasibility. And why does that happen? It's very much as our thinking is often very flawed. I think if you look at Wikipedia, you can see there are about 180 cognitive biases recognized. But you can group those all into either too much info, not enough meaning, we need to act fast. How many of you have heard the comment, faster to market? We need to fast track this project. And what should we remember? In other words, how much information can we physically remember? So if we're going on intuition or gut feel, or I've done it this way in the past, how much do we actually remember? Or do we have selective memory? So I just want to highlight a number of the biases that we are prone to in the mining industry. Firstly, familiarity or overconfidence. We tend to go with what we know. And rather than look at the example I've given, for example, is we know the obvious benefits of diversification in the portfolio. But we made money on a particular asset class. I'm talking about investor here. And so we stay with that one because it's what we know. And we don't actually recognize the fact that we should be diversifying an investment portfolio. Self-attribution, this is a big one. An entrepreneur will often attribute the company's success to him or herself rather than the team. But when things go bad, we've all been there, we blame these external factors for what goes wrong. And this is one that I have seen quite often in the industry. Anchoring, and the example I've given here, So we stick with the first number we told. How often have we done resource estimates or done a valuation estimate and we've come up with a number and we know it's not the right number, but we're putting a number out there because this is our first stab at the numbers. And as we go along and we refine our estimates, we come up with a different number, and decision makers tell us, but you told us a different number. So we anchor it. And I've given the example here in a salary negotiation, and this is good advice. The first number mentioned is usually the anchor point. We anchor on that. So if you go into a job interview and they say, how much do you want? You can't change that number. So it's an important number to actually put on the table. Survivorship bias, this is a really big one. I think Warren Buffett has expounded on this in previous years in terms of, what's he called it, the 2 and 20 brigade. The survivors are a small percentage of the total number of people who try to start funds. But we look at successful entrepreneurs as the only population out there. We don't tend to look at the ones that actually have been unsuccessful. And we don't investigate why they've been unsuccessful. The halo effect, I've seen this so often. A person or a company that's very good in one commodity, for example, doesn't necessarily imply that that person or that company is good in another commodity or another situation. And we'll often attribute that expertise to that person or company, incorrectly so. And probably my favorite, because I've come across it so often, gambler's fallacy. The past doesn't predict the future. If you toss a coin, every single toss says you're still going to get 50% chance in an unbiased coin of getting a head or a tail. And yet we so often think the past does predict the future. Okay, so that's we could go on in a lot of detail on biases and how they impact them. I've got examples of all of these from my 40 years history, and certainly would be happy to discuss some of those, but many of them, impact people around us, and we all are aware. And I think we should look at our own histories and have a look at see when we have come across these biases and actually learn from our own experience in that regard. So what are the ways to overcome bias? So very simply, focus on the goals, remove the noise. So what are you trying to achieve out of, say, a project development? So secondly, trust the math. The financial modeling really should give us a good indication. I mean, there are times where we don't trust it, where we just look at the numbers and say, no, those are absolutely wrong. But most of the time, if we've done our work well, we should get a good indication of whether that project is viable. The third one is probably the hardest one. We don't like to be told that our project doesn't look good. But we should go out of our way to actually search out people or information that actually disproves our preconceived ideas. That's one of the hardest things to do. I find it incredibly hard. However, one way of getting around it is to have a formal process of independent reviews. So continuous open feedback allows us to actually investigate those preconceived ideas that we have, and are we really on the right track with our project? And to underpin that, develop standards and procedures. So when you are reviewing a project, do it all according to the same rule book. This is just one way of looking at it. Use a structured approach. This is one that was developed in a previous company that I worked with, and I've used it successfully in many workshops. So starting with problem framing, the many projects that I've worked with have not done this part of the process well or at all. What are you trying to actually answer in your project? And I've sat in groups of 10 people who have spent a whole day trying to answer that single question. And absolutely amazing how little thought we actually put into it. We are engineers and scientists. We jump into solving the problem without, first and foremost, trying to figure out, is this the right problem to solve? Then by going through a process of raising issues, ranking issues, deciding which decisions we can influence ourselves, and drawing up a strategy table, we can then come up with fit-for-purpose financial models. This particular process is well designed for concept study and pre-feasibility study work. So just, I think this is the second last slide, and let's just check my time. We're doing quite well on it. So I would like to just go through what constitutes best-in-class systems in terms of project development. We know that a rigorous discipline definition of opportunities is important. There, going back to what I said in the previous slide, a problem framing. Now, when a workshop is a critical thing when you start off on a project at whatever phase that you're actually looking at. And this can be applied as much to early exploration, to advanced exploration, to your whole project pipeline itself, and right into execution. Building a project pipeline is a critical thing in terms of building a company's overall health to investors. So having a project pipeline that has a range of projects from early stage exploration into operation, to me, is the way to attract the right kind of investors into the company and to keep them there. Secondly, the staged approval process. At times, I have had concerns about this. We too often in the past skip the pre-feasibility stage. We do a concept study and go, we think we know exactly where this project is going. We know how to develop it. We'll go straight into a feasibility study, and it usually is associated with words like, we need to fast track this, we need to foster to market. Many times I've seen those go straight into feasibility study and then go around in circles because not enough thought has gone into how are we going to develop that project, and have we looked at enough alternatives on how we're going to develop that project. The third one there, and these are in no particular order, value improving practices. This is absolutely critical in the feasibility study stage. I think there are about 10 key ones that have been defined, and I think we'll have a look at them in subsequent seminars on what are those key 10 value improving practices. Fourth one I highlighted in the previous slide as well, independent reviews. The governance, call them IPRs, independent peer reviews, independent project reviews, absolutely critical to have those, especially at decision time at the toll gates when money is going to be committed to the next phase, and particularly into execution. Ensuring that IPR is a strong IPR and not just a box ticking exercise, that is based on standards and procedures, is critical to an effective governance process and to actually an improvement of that process. I have seen so many times where the independent peer review team, just by bringing in a fresh pair of eyes, bringing in different perspectives, looking at things differently, has added significant value to a particular project, more particularly in the early stage of that project than in the late stage, but that's just from my experience. Single point accountability is so important in the projects. This is the next one. So to have that clear accountabilities, number one, and single point accountability, number two, at all levels is important. Now, quite often when we do projects, we multitask. So we, for example, have partial people. So let's say a geologist in a team might be working on 3 or 4 projects. Now, it's very hard to have single point accountability and to get dedicated time when that person is only giving you for example, 10% of his or her time. But it's absolutely critical to know who's signing off on the resource model and by when. And even if you have partials in your team, to have that accountability clearly defined right up front, and not decide at the end of the project, oh, we need someone to sign off on our resource or our reserve or our financial model. Going back just to the independent reviews, I have looked at many financial models where the technical people haven't reviewed the inputs. I would say that that is a critical thing for the project health, is to ensure that your grades, your tonnages, your recoveries, your costs are reviewed by the technical people, your geologists and mining engineers, metallurgists, who are developing those numbers. The continuity of key people, the next one, is absolutely critical as well. Change your project manager and you can set it back significantly. Using integrated teams, so using cross-functional teams, is also critical. I feel quite strongly as well that in-house resources, dedicated in-house resources to develop or shape the projects are critical. So I would strongly recommend that companies have in-house resources to do their advanced exploration, their opportunity assessments, their concept studies, and even up into pre-feasibility. As you start getting more involved in the engineering aspect, outsourcing that part of it, I think, is the right thing to an EPCM or whatever contract that you would prefer to have. And then have your system well documented and benchmark. In my experience as well, just on terms of front-end loading, you can destroy a project through poor front-end loading, and you can turn a 15% IRR into a -10. With good front-end loading, you can increase your returns. And that brings me to the end of it. We have a couple of minutes for questions, and I just want to very briefly summarize what I've been trying to sort of put on the table here for discussion. I believe structured, phased approach to project development with proper toll gating and governance at the end of each phase within well-defined limits. In other words, having all of your project standards agreed on before you do the governance is the right way to go. Valuation, the metrics help us determine the right project value. We really need to trust what we do in our valuation models. Critical point that I made in the previous slide, get the technical people need to sign off on that valuation model. When I give more intensive seminars on valuation of mineral projects, I show quite clearly that if you develop a very complex model that no one can read and no one can understand and no one can follow the math and the logic, the problem doesn't sit with them, it sits with the developer of that model. Models must be easy to understand by everyone involved in the project, and they must be able to follow the logic and the math in those models and see quite clearly that the numbers follow through. I reviewed a mineral sands project where, when I followed through one of the minor elements through to final recovery, I worked out that it had 150% recovery. Now, that was a model that had been reviewed by a major accounting firm. They wouldn't pick up that as an issue, whereas a technical person certainly would. And then have a structured approach to decision making. I've just shown you very briefly one structured approach. Get people in the room who are going to be naysayers, who are going to challenge, who are going to reduce the impact of the one key person in that room who everyone listens to. Break them up into subgroups, but have a structured approach to decision making to allow everyone in that project team to have their say. And final one, which is a subject of a complete seminar on its own, have a good balance between intuition and research. Those who have been in the mining industry for many years have very, very good intuition. often can't explain why they actually know certain things, but they do. But if you balance that with doing the numbers, doing research, you should give yourself a better chance for making good decisions. So those are my thoughts. I think, Connie, we have 10 minutes, so we're probably spot on time. So happy to open the floor to discussion and any comments, and I'd really appreciate any comments from your experiences.
Okay, well, thank you very much, Matt Mullins, for that presentation. It was definitely very insightful. We do have a question from Mark Button. The question is, the focus on capital expenditure accuracy at the expense of OPEX, build-up, and reserve grade has compromised many projects. Would you agree?
Mark, hi. If I could answer that a little bit in my experience, I have seen the focus on capital expenditure accuracy being incorrectly applied compared to the phase of the project. So I'm going to answer this in two parts. So I've seen a concept study done to a plus or minus 5% capital expenditure accuracy without checking, is it the right concept study? So that is sort of part of the answer, but I think your question is at the expense of OPEX. So when you look at OPEX, I agree with you fully. I think we do, let's talk about a feasibility study, and we'll do our capital expenditure to plus or minus 10% or 15%, and we'll do it really well. We'll do our contingency, our escalation, we'll work it out really, really well, and then we'll thumbs up the OPEX. Absolutely, I've seen that so many times. So yes, in that respect, I do agree with you. The ramp up is exceptionally important. So I use an example of Minas Rio in the big Anglo-American iron ore project in Brazil, and they've published all of their numbers, so you can look at the impact that that slow ramp up has made on the NPV of that project. It is huge. Now, if you look at the work done by an Anglo guy called McNulty, and those of you who know the McNulty curves, they work. The 4 McNulty curves need to be looked at in clear detail. I worked on a project that was not a new, but an unproven technology in terms of smelting, who had a ramp up and overall performance better than McNulty 1. And that raised alarm bells left, right, and center, and obviously incorrect. So look at those. So ramp up, extremely important. For good ramp up, look at Las Bambas in Peru, absolutely fantastic ramp up. They did it according to McNulty 1, if not better. The third question, the reserve grade has compromised many projects. I'm not quite sure what you're looking at there. I think maybe the published reserve grade, in terms of what we publish externally for regulatory reasons in terms of JORC, often you will mine differently to that because you certainly don't necessarily have to mine to your reserve grade. You can modify your cut-off grade in the early years and in the late years, whereas your reserve grade doesn't actually reflect that level of complexity in terms of your mining. It also might not reflect the level of complexity in terms of deleterious elements. It gives you a point in time that you can sign off, and quite rightly so, but actual mining could be different when you look at your 5-year plan, for example. Okay, so
Mark had just...
So I see overestimate of the scheduled head grade. Yeah, I've seen it in a number of projects. I've seen underestimate as well. Have I seen a consistent bias in over or under? Not necessarily so. A copper porphyry I worked on in Chile had lower recoveries, but the head grade was higher, but lower recoveries because we underestimated the amount of clay minerals in the ore body. And so the recoveries were a couple of % lower. I've seen head grades, so the practice of cutting in high nugget environments can tend to lead to underestimate of head grades. And I've seen that a couple of times, especially when you've got nuggety coarse gold. I'm referring to gold in particular. So Mark, it's a good question. I might have to look back and see if there is a consistent over or under bias in head grade. Might be commodity specific, perhaps. Anyway, good question.
Okay, seems like there aren't any more questions, but thank you for sharing your email on the screen. So I definitely think if anyone has any more questions, do feel free to reach out to Matt, and I'm sure he'll be happy to answer any of your questions.
I'd like to thank you all for listening. I really do appreciate it.
Okay, thank you, everyone.
Thank you.